Okay. So we are done with the revenue grant, and now we are finally left off with capital grants in terms of accounting. And with that, we have a small tiny part, and after that, we can conclude this standard as well. Okay. So examples of capital grants would be, for example, you all might be planning on buying plant and machinery for the company, right? So government, what they will give is sometimes they won't give you cash. If they give you cash, that would be treated under revenue grant. If they give you capital items such as plant and machinery, which has zero carbon dioxide emissions, or a renewable factory, what government would do is they will reduce the cost. They will reduce the cost and give. For example, the market price is 150,000, they'll give it at 75,000. That is called as capital grants, a reduction in cost. Okay. So now those kind of assets. And also, what if you are planning on buying motor vehicles for your company for the distribution process, right? So those also, if you are buying motor vehicles which have less carbon dioxide emission, then that will also be treated under your capital grant. So these are the examples of capital grant. Okay, you won't get cash. If you're getting cash, that is treated under revenue grant. Okay, so in this also there are two methods. Now you can come and ask, why do they have multiple ways of presenting it? Well, to be honest, I don't know. It is related to the standard. Okay, it is what the standard says, so we are supposed to follow it. Okay. So in terms of capital grants, this is also can be presented in two different ways, right? Method one and method two. Let me tell you how. So let me change the pin as well. Okay. Your method one, what you will do is you have the initial cost of the asset, right? Initial cost of the asset. From that cost, what you'll do is you will go and deduct the capital grant. From that cost, you will deduct the capital grant, right? So I'll show you how and what will be the financial impact. Now, earlier, for an example, take your earlier, your cost was 100,000 of that asset, right? You had a useful life of 5 years. You know, when you buy an asset for the company and if it's used for business purposes, you need to do annual depreciation, right? So you get an annual depreciation of 20,000 per year. Okay, 20,000 per year. That would be your annual depreciation, right? But now, in case if you get capital grant, according to the rule, what you can do is from the cost, you can deduct the capital grant, right? Here it is. The initial cost was 100. You deduct a grant of 25. Say you received here, see, assume that capital grant was 25K, right? So what would happen to the cost? Your cost would come down. When your cost comes down, your depreciation also will fall. Your depreciation also will fall. See, from 20,000, it is fall into 15,000. Why? Because your cost reduced. Why did the cost reduce? Because from the cost, what we went and did was from the cost, we deducted the capital grant, right? So now you all can ask, what will be my financial impact? Simple, right? Earlier you had to pay 20,000 depreciation. Now you're paying 15,000 depreciation. Okay, because of this your profits will increase. Why? Because there is a reduction in an expense. That expense is called as depreciation. There is a reduction in your depreciation expense. This is one way of presenting it. You simply take the cost. From the cost you deduct the capital grant and then you calculate depreciation, right? This is one way, right? If you ask, yes, if you ask the double entry, if you ask the double entry, it would be debit bank, right? It would be debit bank, and you will be reducing your property, plant, and equipment. You will be reducing your property, plant, and equipment. So, why will you be reducing? It is depreciation. You will be reducing it by the depreciation, right? So, that is method number one, right? That is method number one. Okay. Now, let's move into method number two. Method number two is what we know already. Method number two is what we know. What method number 2 is, let me take another pen again. What method number 2 says is, treat it as income received in advance, right? And transfer it to each year under the grant income to P&L. So what it says is, for example, if you receive that 25,000 grant for 5 years, what you need to do is simply treat it under income received in advance, right? The current year grant will be shown under the current year. The remaining 4 years will be shown under income received in advance. So each and every year, your from your non-current liability, you will be transferring into your profit or loss. So automatically your income received in advance will reduce. Okay. So the double entry for that would be, you're getting debit bank, right? And it will be credit deferred income or income received in advance, which could be your non-current liability and current liability, right? So you all can ask, what's the financial impact? The financial impact would be, see, in this particular part, you're not going to reduce the cost, right? So your depreciation will be higher. The normal way of depreciation, your depreciation will be high. Give me a minute. Just give me a minute, but here it is. Your depreciation will be higher. Why? Because you're not going to reduce like the previous method that you all did. You all went and reduced the cost from, you all reduce the grant from the cost. In this, you all won't be doing that and all. You will just take it simply as it is, right? So depreciation will be higher, right? Why? Because your cost will not be adjusted, right? But this increase in depreciation can be offset. How can it be offset? How can it be offset? How can this be offset? You all know, right? Each and every year, you all will be transferring from your deferred income or from your income received in advance account, you all will be transferring to profit or loss, right? So that transfer is known as an income, right? So that transfer is known as an income. That income will set off your depreciation, right? That income will be setting off your depreciation. So how would you record this? Debit deferred income, right? Because your deferred income is a non-current liability, or non-current liability will be reducing, and you will be crediting your other income, right? So that is when you do the transfer. When you do the transfer, okay. When you do the transfer, so let me write that also. Transfer each year, double entry. We initially recorded debit bank credit income received in advance. Now what we'll be doing is, each year when we transfer, we'll be doing debit income received in advance, and we will be crediting our other income, right? This is if you're transferring each year, right? So now where we told in this method our depreciation will be the normal depreciation. It will be higher. Why? Because we are not altered the cost, right? But how we are going to reduce it, how we are going to bring the same impact is, we'll find out the depreciation. The depreciation is 20,000, the normal way, right? What we'll do is, we'll be adding grant income, right? We'll be showing off the grant income. So a final profit or loss would be 5,000. This would be your financial impact. This would be a financial impact. Can you see? 20,000 would be shown as expense. 25,000 would be shown as grant income per year. So 5,000 would be a profit, which is your increase in financial impact, right? Now, don't worry, in your exams, they would not ask you what would be the increase, what would be the decrease. They just simply ask the double entries, or they will ask some questions related to capital grants. Right? Now we are going to look how it can be tested through a question. Here it is. This is how it can be tested. An entity opens a new factory, right? Can you see? They are opening a new factory and receives a government grant of 15,000, right? Now this was not maintain full employment, attract investment, nothing of that sort. They are opening a new factory, and because of that new factory they're producing, say that factory has reduced carbon dioxide emission, you will be getting a capital grant. You'll be getting a capital grant. So first step is you all need to identify whether this is a capital grant or a revenue grant, right? So it depends on question to question. When we practice it in further, we'll be able to understand, right? How much you receive? You receive 15,000 in respect of capital equipment costing 100,000. So the cost was 100,000 and you'll depreciate it at 20% per annum at straight line basis. What the question they're asking is, how do you present this capital grant in two different methods? So we learned here, right? We learned here. There are two different methods that we learned. So now what I want y'all to do is pause this recording, watch this, and y'all try to do your test to understand. After y'all are done, again resume the recording and try to see whether your answer and my answer matches. Okay. So let us go according to our first method, which is your net cost method. Right. So what we'll do from the cost, we'll be deducting the grant. We'll be arriving at a net cost. The net cost will be obviously lesser. Okay. Why it will be lesser? Because we are deducting the capital grant. We are deducting the capital grant. Right. So 100,000 was the cost. Your capital grant was 15,000. Right. So you'll be arriving at a cost of 85,000. Right. On that 85,000 only, you'll be charging 20% straight line depreciation. And you all will be coming up with a depreciation per year of 17,000. Right? If you all did in the normal method, how you all would have come up with 100,000 into 20%, which is 20,000, it would have been the depreciation. Right? So this method is favorable. This method is favorable. Why? Because it is reducing your depreciation by 3,000 rupees. Right? Because your earlier method, you from the cost of 100,000, you do not go and remove government grants. Right? You do not go and remove government grants. Okay. So this is how you do it. How do you present it? Depreciation is an expense. You'll be showing 17,000. Right? Will you be going and showing a separate line item as under other income as government grant income? No. Why? Because it was already adjusted. That grant income was already adjusted in your cost. So you do not go and show it here. You do not go and show grant income. Why? Already adjusted in cost. Right? You do not go and show a grant income. Why? Because the grant income is already adjusted under cost. Now in terms of balance sheet. Under cost, will I be showing 100,000 or will I be showing 85,000? I need to show 85,000 only. Why? Because I need to show that adjustment, right? I need to show that adjustment. So under non-current asset, because this asset is used for a business, you'll be showing 85,000 minus your depreciation is 17,000. You will be arriving at a figure of 68,000. You will be arriving at a figure of 68,000. Right? So that will be your non-current asset. That would be your net carrying value of your non-current asset, 68,000. Right? So this is method number one. So I'll tell you all a summary. So method number one is quite simple. The summary would be is from your cost of the asset, you simply go and deduct the government grant. What will happen? Your depreciation will be lesser. Your depreciation will be lesser. When you are planning on presenting in your statement of profit or loss, you will only show depreciation. The reason being is because you'll only be showing depreciation is because the government grant was already adjusted in your cost. You do not need to again go and show it under your profit or loss as other income. Right? Method number two. You have to treat the entire amount as income received in advance. Right? Give me a minute. You'll have to treat everything under income received in advance. Okay. So how you'll be doing? You'll be initially debiting the bank by 15,000 because that was the grant that you received. Right? Now you need to bifurcate, right? You need to allocate which is for current year, which is to be written under income received in advance under your non-current liability, current liability, right? So how that would be done is, your current year, you will be charging 3,000 under your income. You will be charging 3,000 under your income, right? How that would be coming is 15,000 would be your grant at 20%. You'll be charging 3,000. So the remaining 12,000 will be taken under your, give me a minute, will be taken under your non-current liability and current liability, right? So this is how you present it. Now in terms of profit or loss, in this, you can show a separate line under other income as grant income, right? Because in this particular method, we did not go and adjust under the cost, right? So depreciation would be normal. Depreciation would be the normal. You will be multiplying 100,000 at 20%. Why? The cost was not adjusted. So depreciation would be 20,000 under this method, right? So this depreciation is high. This depreciation is high. How will you reduce? How will you reduce it? How will you reduce it? You just simply show another line. You show another line as grant income and show plus 3,000. So net expense would be 17,000 only. Your net expense would be only 17,000. Can you see here? Can you see here? Under this method also, your expense was 17,000. Under this method also, your expense is 17,000, right? So there is no difference whether you treat it under method number 1 or method number 2, right? Both we will be arriving at the same value. Both you will be arriving at the same value. It's just the presentation differs. In the method number 1, you only showed one line item. In method number 2, you're showing two line items. Simple. But the answer is the same, right? Whether you use method number 1 or method number 2, you will be coming up at the same answer for your capital grant, right? Okay. How will you present it in a balance sheet? How will you present it in a balance sheet? How will you present it in a balance sheet? This time your carrying value will be 80,000, right? Which is 100 minus 20,000 depreciation, right? And your, yes, you look at this part. Look at this part. Your non-current liability will be showing 9,000. And since you need to pay next year also, you need to pay 3,000 per year. Next year also, you need to pay 3,000 per year. This will be shown under your current liability. This will be shown under your current liability, right? And in terms of, yeah, this will be shown under your current liability, right? So we are done off with our both capital grants and revenue grants, right? There were totally 4 methods that we learned, right? So regardless of whatever the method that you all use, you all will be arriving at the same answer. You all will be arriving at the same answer, right? You all will be arriving at the same answer, but don't worry. You will be getting majority of the times for capital, for government grants, you will be getting only MCQs majority of the times. So you all don't need to do lengthy workings. You all will be only getting MCQs, right? Despite of whatever the method that you'll use, you all will be getting the same answer. Okay. Finally, we are moving on to the final part. Okay. Repayment of grants. I told you, all right, if the company does not stick to its promise, or if the company breaches any of the promise conditions, then government will tell, give me back my entire amount to the government. Give the entire government grant back to the government itself, right? Why? Because you breached the contract. You breached the contract. You see, when the contract is breached, then the whole grant has to be repaid back to the government, right? But you all need to know, if I am planning on showing this as a payable, obviously, right? If you need to repay it back to the government, that will be considered as a payable, right? It will be considered as a non-current liability payable. So you all will only be recording it as a non-current liability if that payable, give me a minute, if that payable is probable. Hopefully, I'll remember under your foundation, you all learned IAS 37. We will only show non-current liability if it is probable, right? Now, I did not have time to write the double entry and all. So what I did was from your tudes, I have taken a snipping and attached the double entry, right? So if you use the netting off method, what is netting off method? Netting off method is the cost minus government capital grant. What you all will be doing? You all need to pay grant, right? So that will be under your non-current liability, which is a credit. And you all will be debiting your property, plant, and equipment. Now you all can ask, why do I debit? Why do I debit? Can you all see here? Let me use another pen. Can you all see here? When you all obtain the grant, under netting off method, you all would have gone and deducted government grants, right? Under netting off method, you all would have from the cost, you all would have gone and deducted your capital grants. Now this part needs to get cancelled. This part needs to be get cancelled, and the cost needs to be bought into its original value, right? So how will you bring it? You just simply need to increase your cost in P, right? You all need to just simply increase your cost in PP. So that is why debit property, plant, and equipment and credit grant payable. All right, let me again repeat it myself. If you all are using netting off method, what you all would have done, you all would have reduced the cost. You all would have reduced the cost. But now, since you all were not able to meet the conditions, you all need to repay it back. So what you'll do, you need to repay it back, bro. You'll be showing as credit grant payable, right? And you'll be debiting property, plant, and equipment. Why you will be debiting is you have to bring your cost to its original value. That is the value excluding your capital grant, right? So that is double entry when you have to repay under netting off method, right? For deferred income method is on capital grants, then any remaining grant will be repaid to the government. Any amount released to the profit or loss may also be reversed depending on the revenue. So what will happen is, uh, you all would have gone and showed it like this, right? Let's show this also. You all would have gone and showed it as credit other income and debit deferred. You all would have shown like this earlier. This has to be reversed. This has to be switched. That is it in terms of repayment of grants, and that is it in terms of this particular standard. If you all have any questions, let me know. We could have a discussion on that. And don't worry, I'll be uploading another recording which includes some questions from your past papers. Right? Thanks for joining in.